Okay, hello everyone. Thank you for coming and joining us today for the McGill Women's Alumni Savvy Women Investors webinar series. My name is Keeley Simpson and I'll be guiding you through our presentation this afternoon. We have about 1 hour allocated and our goal is to get through as much of the information as possible and also just try to do some Q&A as well. So if you have any questions that come up during the session, please feel free to put it in the chat box. And from there, we'll basically be able to take some questions as we go through the presentation. So just a little bit of background about myself. I'm based in Toronto, Ontario. I've been with BMO Nesbitt Burns now. I'm celebrating my 15th year in a couple of months, which is very exciting, except that makes me feel a little bit old. I'm a portfolio manager and a senior wealth advisor with BMO Nesbitt Burns. I run a primarily discretionary investment management practice with my business partner, Lee, and we're a team of 4. So we have 2 other people that work with us as well. I'm also a mom of 3 little ones, and I'm expecting my 4th one in a few weeks, in 6 weeks. So it's a very busy house, so to speak. And that's, that's I think, sort of covers my background and my history. So again, if you have any questions, just put them through the chat, and we'll be able to go from there. So, okay, I'll just see if the chat is working. Here we go. All right. Perfect. It's loaded up now. Okay, so the first slide here is that money is genderless, but investing for women is different. And what I mean by that is, just generally speaking, this is a generalization, of course, is that women tend to be less confident in their knowledge when it comes to finances than men are. And then this uncertainty extends to financial and retirement planning. And so that's why we're doing a session today specifically for women, so that we can review some of the nuances as to why investing for women is different and why planning for retirement for women is different than our male counterparts. The next slide here is planning is bringing the future into the present so that you can do something about it now. And what I mean by that is, whatever reason you've decided to attend today, you have some goals in mind. And in order to reach those goals, we need to do some planning ahead of time to make sure that you can get to where you want to be. So the agenda for today's session is we're going to start off with a little quiz. So I get your notebooks or just, like a little notepad on your computer or your iPad ready. We're going to talk about why investing for women is different. We're going to talk about some of the unique challenges that women face in planning for retirement. And then we're going to talk a little bit about some of the basic steps to building your net worth. And then we're also going to talk a little bit about some of the differences when it comes to selecting an advisor, working with someone who works at the bank, and so on and so forth. So let's start off with our quiz. So right now, to maintain your current lifestyle, if you were to stop working or you were going to retire in, I don't know, 30 years, 40 years from now, how much capital do you think you'll have needed to have saved? So obviously our audience today is on the younger side, so I don't expect for you guys to know the answer to that, but it's just a little bit of a question to get you to start thinking a little bit ahead in your financial planning goals. What are some of the sources of retirement income? So if you're working for a company right now, do you have a company pension plan that the company is putting funds into for you, or are you both contributing? Do you have an RSP that you're saving inside of, or a tax-free savings account? How much will each source of retirement income provide you with? down the road. So again, these are sort of longer term planning questions, but it's good to go through when it comes to financial planning. What percentage of your gross income right now are you currently saving, if any at all? And what would be the percentage of that on a net basis? So how much you what your take home is after taxes. And if you are currently investing, what was the return on your investments in the last 12 months? So I'll give you guys a few minutes for that. So let's talk a little bit about women. So again, these are just generalizations and they're all based on studies that have been conducted over the years. But just generally speaking, women tend to like to learn a lot more about what it is that they're going to be investing in before actually investing. Men tend to take a bit of a different approach when it comes to investing. Women have different life experiences, so we tend to communicate differently than men do. And and that's it's not a good thing or a bad thing. It's just a product of, women have different experiences in life. And just another generalization, and this is not true for everybody, but based on these studies, they do say that, women tend to be more risk averse and that men tend to take more risks. And I think that it's just because of this this fear, like I don't want to be a bag lady down the road, things like that. Like it's just that women tend to be more conservative with their investments. And then some of the unique challenges that women face in planning for retirement down the road. So again, because our audience today is on the younger side, these may or may not be relevant to you right now. And of course, things are going to change over the next 20 years as you get closer to even thinking about retirement. But right now, some of the unique challenges are that it's typically presented as a couple experience, which, is a lot of the times women, end up, becoming widowed or divorced or never married. So the fact that it's always presented as a couple experience, obviously, can be a bit challenging, expecting two different incomes in retirement, right? Generally have a smaller nest egg if you've left the workforce to take care of kids or even just to take care of your parents. Women are living longer than men are, and women are living even longer today. I saw that yesterday the oldest woman alive in Quebec has passed away at 114 years old. So we are living longer than ever before. And I'm not saying that we're all going to live until 114, but it's important that we take a really long-term approach when it comes to planning for retirement once you do retire. And then, some of the non-financial aspects of retirement are that women do come out ahead. And that's because it's more personal identity. It's not identity based, right? Where men tend to link their identity with their work. Women tend not to do that based on all of these studies that have been done. So I do have a worksheet that is available. It's an Excel spreadsheet. If you'd like to try and do a budget for yourself or keep track of all of your monthly expenses, over here, it's all sort of laid out for you, and it does current expenses versus future expenses. So it takes into consideration inflation to show you, what the expenses would be in 10, 20, 30, 50 years based on inflation. So if you would like this spreadsheet, just let us know. There's going to be a survey sent out at the end of today's presentation. And there's two different surveys. There's one that McGill has and one that a link that I've sent out as well. And if this is something that you would like for me to send to you, then please just put it in the Survey Monkey that you'd like to have this worksheet sent to you, and I'll send it off to you as quickly as I can. And then there's maybe some other information that you'll see during this webinar that maybe you would want to have access to as well, just let me know and I'm happy to send that off to you. So again, we're not going to spend too much time on the retirement stuff just because we do have a younger audience today, but I just thought it would be good just to show you some of the things to think about down the road. So women are living longer. It's no longer a set point in time. It used to be that, you turn 65 and you retire. We're seeing right now with a lot of my clients, I'm seeing the sandwich generation where women are taking care of their younger kids as well as their aging parents at the same time. And this has not been easy for a lot of people, especially during the past couple of years living through a pandemic, dealing with, online learning, dealing with retirement homes, in and out of outbreaks from COVID. I mean, it's been a very challenging couple of years for many, many men and women, but I feel like women have taken on more of that responsibility through the pandemic. We do have something called a declining pension that we need to be aware of. So it used to be that companies would put in, would do a defined benefit plan for their employees, and companies don't like to take on the risk of that anymore. So they do what's called it's not a defined benefit plan anymore. It's just like a group RSP savings plan that they have for their employees. So this is something to be aware of, where you're likely not going to retire with like a guaranteed pension income from the company that you're working for. You'll be saving together with the company. It's just something to be aware of, that a teacher's pension is great. Obviously, that still exists, but in many cases, we're seeing declining pension numbers. And a lot of people now are retiring with more debt, and that's just a factor of housing prices and inflation, etc. Some of the sort of rules of thumb or myths, or things that clients bring up to me when we're doing our planning is, I'm fine to have a company pension plan. This can be true, but again, a lot of the times we need to do some extra saving to meet the cash flow needs. I need to save 70 to 80% of my pre-retirement income. I've heard that I need to save $1 million. This is from a long time ago. We need to save a lot more now. And then I will be fine if I only withdraw 4 or 5% a year from my savings once I retire. This is my favorite one because that is true. You can think about it like a 5% number, except that you want to make sure that your investments are earning a higher return than inflation in order for that to be true. And then I don't know if anybody saw this morning, but our inflation numbers came out in Canada, and we're almost at 5% inflation. And in the US last week, they announced an almost 8% inflation rate. Obviously, that's a sign of everything that's happened with the supply chain, labor shortages, I mean, you name it. But right now we're seeing inflation as a big concern. Obviously, when you go to retire, things will be much different, but it's just something to think about, that these economic changes can have an impact on the plans that you may have. So as I mentioned before, women taking care of their parents, leaving the workforce for a longer period of time to take care of children, adult children returning home, caring for grandchildren so that the parents can work, outliving your spouse, so becoming a widow, divorce. What does this all mean? Does it mean that you're working longer? How much and in what capacity, right? So this is my favorite part of the presentation. We're going to build our own plan today. So get your notepad out and let's start building our plan. And if you have any questions, just a reminder to send them through the chat. I have it loaded up and I can see it. So if you have any questions, please feel free. I know it can be hard to have an interactive session online, but I'll try to make it as interactive as I can. So the first step in building, the basic steps to building your net worth is to have a plan. So you want to create a balance sheet. And what I mean by that is, how much do you spend and how much is left over? We wanted to create a statement of net worth. So do you have any assets versus liabilities? So if you have a house or a condo or anything like that, assets minus liabilities. The net is your net worth, and then that can determine your net number. And then you want to pay yourself first. This is really important. We always, as women, we tend to take care of everybody else first. So I think in this particular case, you really want to emphasize yourself and you want to pay yourself first. How much can you save and how much should you be saving to reach your goals? So you want to have a budget. So that expense worksheet that I had before, if you'd like to have that, just let me know and I'll send it. You want to have an emergency fund, which makes up a few months worth of, monthly cash flow from your job. RSPs versus TFSA, we're going to talk about that in a few minutes. And you want to have a reinvestment program. So I see that some of the questions have come in. Okay, so these are really great questions. So why don't I save some of these for at the end of the presentation, and then keep sending them through. And then if there's a question about something that I have on the slide, then I can answer that. If it's a general question like the ones that are coming in right now, then I'll save those for the end, and we'll try to get through this as quickly as possible so that we can have lots of time at the end. So we want to set our objectives. So I don't know, these are the different goals that are out there. Do you want to buy a condo or a house? Is there a major purchase on your horizon? Do you want to buy a cottage? I have a client who, she works all the time and she's working from home from her condo. And now we're talking about, maybe her major purchase goal should be to buy a condo, a cottage, so that she can go somewhere to relax and work from her cottage, since it's all, work from home right now still. Retirement, if that's a goal. Children's education, so if you have young kids, how do you save for their education? Estate planning, any proceeds of insurance, any gift planning. That's been a hot topic of conversation lately with a lot of my clients. So the next is you want to develop a retirement plan. So these are the three sources of retirement income, generally speaking. So we have government plans, so your QPP or CPP, depending on which province you're in. Company pension plans, right? Or personal savings, RSP, and tax-free savings account. If you were to replace today's income, and this is actually based on a 5% inflation rate. So if things don't get a little bit, better over the next few years, this just gives you an idea of, if your income today was 60,000, to replace your income today 10 years later based on a 5% inflation rate, it would be like 98,000 a year. That's 5% inflation. And that's why inflation is important. That's why we talk a lot about inflation when it comes to planning, because it hinders our ability to afford the things that we're able to afford today. So an apple today is not an apple tomorrow, so to speak. And actually, I went to the Pet Value. I have 2 dogs as well, and I was shocked because there's this one specific type of treat that my dogs really like, and it was $3.49 before the end of the year, like back in 2021. And I went to buy them again, and they've upped the price now to $4.38. I was baffled by this increase. So, things are getting more expensive. So the advantages of an RSP is that there's tax deductible contributions and tax deferred compounding. And what that means is the money that you invest inside of your RSP and inside of the tax-free savings account, whatever you buy inside of those plans, they grow tax-free, which is great because the only other way to get any tax-free increase in value in anything that you own is in your principal residence in Canada. Everything else is taxed. So, and then you want to have obviously the tax deductible contributions. So if you're putting money into an RSP, which is a retirement savings plan, then typically you're going to be getting a refund from the government once you go to do your taxes, which is nice. So these are some of my rules to live by, especially when you're starting out, is open an RSP or a tax-free savings account depending on your situation, whatever makes the most sense. You want to contribute what you can to each plan. You want to contribute early each year or monthly. When I start working with clients who are just starting out and they want to build their net worth, build up their nest egg, what we do is we set up a monthly contribution plan to the savings accounts, or investment accounts, I should say, so that the person gets used to putting in, even if it's $100 a month, right? Like you get used to putting money into a plan so that it keeps growing for you. And then you want to invest wisely, because a 6% rate of return is great. 8% is really good. 10 is obviously, knocking it out of the park. Although last year was a really good year in the markets. And then this year we're aiming for a 10% return in the markets as well. So, but basically what I mean by the 2% difference is that, if you had a plan that was earning you 6% a year, and your savings are growing, your investments are growing, then 29,000 versus 33,000 is a difference. But if you look at it for 35 years, right? 6% rate of return 35 years later, and this is assuming that you're putting in 5,000 a year, is 590,000 versus a 10% constant rate of return is 1,490,000. So it can make a really big difference. Okay. The tax-free savings account was introduced in 2008. You're allowed to contribute right now a maximum of $6,000 a year. The government did keep the limit the same in 2022. The investments inside of those accounts, so the tax-free savings accounts, they grow tax-free. So you're not going to be taxed on the interest, dividends, or the gains inside of that plan. And if you've never opened one, you can contribute $81,500 today if you turned 18 before 2009. So some of the rules are: do not over-contribute. If you do, then sometimes we can have a penalty that the CRA charges us. You don't want to contribute and withdraw and then contribute again in the same calendar year, because that can also create some penalties. So I did something here that I thought would be interesting for you to look at: TFSA versus RSP. So if you're at a 40% marginal tax rate right now, when you contribute to both the TFSA and the RSP, and you were to contribute $5,500 to each plan, it shows you that the net withdrawal would be basically the same. Okay? So in 20 years at a 5% growth. But, and this is the sort of value of contributing to an RSP if you are in a higher tax bracket right now, but then won't be later on. So if you contribute $5,500 to both the TFSA and the RSP, and you're in a 40% tax bracket when you contribute the money, but only 20% when it's withdrawn, then the value of the RSP is much higher. It's at $11,675 versus $87.56. And of course, the opposite is true, that the TFSA holds a lot more value if you're in a marginal tax rate right now of 20% when you contribute and 40% when you're withdrawn. It obviously makes more sense to have the money invested in a tax-free savings account. So, I wanted to show you guys this so that you could understand also what having your investments in a plan for longer would do. So for If you decided that you were going to wait 2 years before drawing on all of the stuff, on all the savings that you've saved, your portfolio will last you an extra 5 years. So this is the investment program piece, which will be good. I think it's actually going to answer some of these questions that we have. So one of the questions we got was, could you talk about saving investing for retirement when you have a pension plan? For example, how do you know how much you need to invest when you have a defined benefit plan, a defined benefit pension plan? I would say whatever extra cash flow that you have available to to create and manage your investment program with, I would put towards it, because you just never know when you're going to need the money from it. And basically, you can look at your current financial picture and your current budget and determine a net number that you're comfortable saving every month. You can think a little bit about your risk tolerance. So how much risk do you feel like you can handle? If it's 100% invested in the stock market, does that make you feel fine, or does it make you feel a little bit uncomfortable, right? How long do you have to invest the money that you're saving? Is it 10 years, 20 years, 30 years, 50 years, or are you planning on buying something with that money in the next couple of years? What level of knowledge are you at right now when it comes to investing? So do you know a lot about the different stocks and bond options out there, or are you just starting out? How much time do you want to dedicate to this? And creating some goals for yourself. So what would you want your net return to be? What would you want your portfolio to grow to? Things like that. A nest egg is, another question was, what's a nest egg? Does this refer to my net worth and my assets? So yes, it does. It refers to your financial assets, because it's whatever you have invested in outside of a pension plan would be your nest egg. So that's what you're growing over time, and you can have access to, whether it's for retirement down the road or education savings plans, or buying a cottage or a house or a condo, like anything like that, that's your nest egg. So the investment menu is pretty is lined up here for you guys. So short term is anything that's less than a year. Fixed income is bonds and preferred shares. And then common equity is stocks. So when it comes to the fixed income side of things right now, interest rates are very low. So you're not going to get a very high return by investing in any of these products that are available to you, although they are guaranteed. And then also, when it comes to fixed income, right now, last year, the bond market actually was down 5% altogether. So just because it's supposed to be conservative doesn't mean that it's going to give you or yield you steady returns every year. So your real rate of return, how to calculate that is you take the current rate of return that you have minus inflation, that equals your real rate of return, minus any taxes you have to pay if the money is invested in a plan outside of your RSP or your TFSA, and that's your after-tax return. So here are the different bond options available for investing. We have government bonds and corporate bonds. Again, they're not very exciting right now because of rates. And according to some economists, we might start increasing rates as early as March. And bond returns have a negative correlation to interest rates. And what that means is when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. So it's just not an area right now that is a very exciting area to be investing in. Preferred shares are also interest rate sensitive, but they do offer you a dividend versus interest, which is more tax efficient if you're investing in it outside of a tax deferred plan. And then you also get a credit rating like you do with the bonds. And the prices should be less volatile than the stock prices, but we also saw a few years ago that preferred shares went down by over 25%. So it doesn't, again, mean that it's all, just because it's fixed income doesn't mean that it's super conservative. And I think my message here is that you want to have a balance between everything, and I'll show that to you in a couple of slides. So the common stock is, any company that's publicly traded on the stock market. You take an ownership in the stock, in the company. If they pay out dividends, you get them on a quarterly basis, and you can qualify for what's called the dividend tax credit. And then you also have capital appreciation potential. And the dividend tax credit, just a note on that, again, if it's outside of a tax deferred plan, like a non-registered plan, that's where you would qualify for it. But inside of an RSP and a TFSA, everything grows tax free, so it wouldn't matter there. So asset mix, what is it? So it's basically a blend between stocks, bonds, and cash. Why is it important? Because it's going to determine your risk and reward trade-off. It's the most effective method for accommodating some of the unique investment preferences that we see out there. So I think if you're creating your own investment program, I think what you want is you want to have a mix between, the stock market and the bond market. But I think if you have a long time horizon and you're able to, quote unquote, handle some volatility, I think given the place that we're in right now, which is a rising interest rate environment and inflation at 5%, and rates being so low, I think you want to focus more on stocks versus bonds. So obviously the pandemic made the stock market crash, back in 2020, but it did recover really nicely. So if you stayed invested, then your portfolio obviously went down quite a bit and then would have come back up. One way to reduce, having your portfolio go down by as much as the market is by diversification. So diversification reduces risk. And diversification is by asset type, by industry, and by country. So the current market conditions right now, and I know we've probably all heard enough of COVID, myself included. But our latest report is COVID-19 morphing into the flu, positive implications for the recovery trade. Talks a little bit about the variant, it talks about some technical analysis, and it talks about some of the names that we think are going to do well in the next few months. If you'd like this report along with the budget expense sheet, please, by all means, let me know, and I'm happy to send it to you. When is the right time to invest? I get this question from, a lot of times from clients. And, I'd say that if you had a lot of cash to invest right now, I would only invest a small percentage in the market right now, just because we're seeing so much volatility. I would keep averaging in every week, because you just don't know what's going to happen right now. The risks of market timing, of course, is that you can miss upswings. And then if you did have everything in a non-registered account, then you might be buying and selling and buying and selling, and you would create some capital gains for yourself. I always say that you want to buy value, but you really want to buy companies that are paying dividends. And that's because you can get paid while you wait. And that, what I mean by that is if the stock market were to go down, or if the company that you bought were to go down, you could still at least get paid the dividend while you're waiting for the prices to recover. The other thing I would say is you want to make sure you have a dividend reinvestment plan. So if you are going to invest in a tax-free savings account or an RSP, and you are going to buy the companies outright, for example, I don't know, RBC, you want to make sure that you have a dividend reinvestment plan on there so that every time a dividend comes in, it buys more shares for you if you're going to be investing for the long term. Well, we've talked about these. So selecting an advisor, we'll talk about in a minute. Just want to see some of these questions that have come in. Okay, so yeah, we're getting lots of questions, which is great. Okay, so I guess I'll just save these for the end of the presentation because we're just a few minutes away from that, and we can have basically all these questions, go through all these questions. So selecting an advisor, if you're going to work with someone at a brokerage, then you want to get recommendations from family members or from friends. You want to find out what their minimum investment requirement is. You want to do interviews, and you want to set expectations. So how many times are you guys going to talk a year about your portfolio, about your plan, and what are the costs going to be? What are the fees going to be to manage your portfolio? These are all of the services that are provided by your advisor. So you have financial planning, setting goals and objectives. They should provide you with investment research and advice. They take care of all of the asset management. They provide you with monthly progress reports, financial updates and portfolio reviews, and service expectations. So what I mean by service expectations is, how many times a year are you guys going to review your portfolio? Do you want to review it once a year, twice a year, 4 times a year? Like what's your preference? Okay, so now that we've gone through the presentation, I am going to talk a little bit about some of these questions that have come in. So if you have more questions, please feel free to send them in. So someone asked, curious to know, with the markets down right now, what would you invest in if you only had a small amount of money to do so? It's a great question. We had a report the other day that was really interesting to me because we have our chief investment strategist. His name is Brian Belsky, and he, for the first time in a long time, has said that he would actually be cautious about any like growth names or names that have double-digit, PE earnings, things like that. So honestly, I would say if it's a small amount, then I would look at like a global type of mutual fund or exchange traded fund portfolio. I wouldn't buy any one name with a small amount of money. And that's because if you were to pick BMO instead of RBC or NVIDIA instead of Apple, and something happens with that one company and you've put all of your eggs in one basket, so to speak, sure, it can work out really well for you. You could get a 40% return, but it could also go the other way. You could get a negative 40% return. So I would say that if you have a small amount of money to invest right now, I would look at exchange traded funds. They're very cost effective. You could open like an online investing account with Wealthsimple has them. Even BMO has a program that is exchange traded fund based. So that's what I would look to do. And I would look at it from a global perspective. I wouldn't just buy Canada or the US. I would just try to do something global. Hopefully that answers that question. The next question is, if you've used your RSP in the first time home buyers program and you're paying that amount back, what do you suggest putting in your RSP as a percentage of your income? Do you want to pay that off as fast as possible to start building your RSP back up? Every time you contribute back into the home buyers plan, there's a minimum amount that you have to do every year. It doesn't count towards the RSP contribution room, and it doesn't count towards getting a credit from the government either from an income tax perspective. So what I would do is I would just do your minimum amount that you have to do every year, take your time, and then try to put in a bigger sum or a monthly sum that you're comfortable with, that makes sense for you and for your tax situation. Because the first-time home buyers repayment program doesn't count towards building your doesn't count towards the tax credit that you're going to get from CRA. Hopefully that's good. In your 20s, is it better to put money into a retirement account or try to pay off more of your student loans early? Well, it depends, because what are the student loans currently from an interest rate perspective? Like, is it 3%, 2%? Is it 5%? I don't know what kind of loan a student loan right now is charging from an interest rate perspective. I think you want to try and pay it down as quickly as you can, obviously, but I think you also want to balance any sort of retirement program or tax-free savings account investing, just because then you can also get a good rate of return in your investment plan, which would allow you to start growing your nest egg. What penalties occur if you contribute, withdraw, and contribute to your TFSA in the same year? Sorry. So I would contact CRA and find out what is your contribution room for your tax-free savings account. If you've not maxed out your tax-free savings account, then you wouldn't incur any penalties by contributing, withdrawing, and contributing again to your TFSA in the same year. But if you've maxed it out, then that's when things get a bit more complicated with the CRA. So I would call them directly and ask them if you're going to have any penalties by, contributing, withdrawing, and contributing again. A tax-free savings account isn't really meant to be used as a savings account. Actually, it's meant to be used as an investment account that you grow over time tax-free. So I would call the CRA and find out what your room is, and if the money movement in and out has impacted that in any way. Is it better to invest in a TFSA or an RSP if you're a teacher? Generally speaking, when you're a teacher, you have a pension plan, which means that your employer, the school, is helping you save for retirement already with a defined benefit plan, which also reduces your taxes every year. So I would say a TFSA would be a good place to start if you're a teacher. Some of the investment strategies, what companies to look for, what do you think a positive company would be? Okay, so right now, what are some of the investment strategies right now? So let's just think a little bit about what's happening in the world. So with COVID, this pandemic, inflation being so high, supply chains are still squeezed. We want to look for investment themes, right? So where are you going to earn the biggest bang for your buck, so to speak? So you want to look for companies that are going to pay you a dividend and that are going to pay you while you wait if something were to happen. And you want to have companies that you believe in. So, a positive company would be maybe a company that's ESG friendly, right? So they have good sustainable governance, companies that are highly ranked on that scale. And then maybe you would want to look at some of the themes that are out there. So, companies that are cyclical in nature, industrials, that's sort of the area of the market that we're going to hopefully see go up. Another area is energy, which is not Some people don't believe that that's, sustainable investing. So, it really depends what your, value, like if you have values when it comes to investing, if that's going to be a key driver for you, then to look for companies that have like a high ranking when it comes to if they're ranked highly as an employer or as a sustainable business. I hope that that answers that question. Okay, so that's all the questions, I think. Let me just make sure. I thought there was more, so that's good. Okay, so if anybody has any other, oh, okay. Okay, so I see a bunch more just came in, so just give me a second here and I'm just loading them up. So the next question is, when calculating the real return, do we need to also apply the marginal tax rate we will be at when selling for non-registered investments? No, I think your current tax rate should be fine, unless you think that your future tax rate is going to be a lot higher. It's your current tax rate that you would use when calculating your real return. Could you talk about the difference between a preferred and a regular share? Sure. So a preferred share is going to pay you primarily a quarterly dividend, which is set at a coupon rate. You're not going to participate in the growth of that company. So the share prices shouldn't move too much between $25 a share, unless there's concerns about the credit of the company. So if the company gets downgraded from a credit perspective, they can't pay their bills, or interest rates become a concern. So that can put pressure on the preferred share price. But generally speaking, they should trade around $25 a share if it's a rate reset preferred. And then there's also different types of preferred shares. There's a floating rate preferred share, there's a rate reset, there's a straight preferred share. So there's a couple of nuances between those types. If you want some information on preferred shares, I'd be happy to send it to you. And then the regular shares, well, those are based off of the earnings of the company. So the earnings of the company should grow the stock price, should go up in value as they keep hitting new targets. And as investors seem to like the company, it should push the price of the company, the share price up or down. It depends. So you'll see a lot more fluctuation. Generally speaking, you should see a lot more fluctuation with owning the stock outright versus the preferred shares. And that's really sort of some of the biggest differences. The stocks should be less interest rate sensitive than the preferred shares as well. What do you think about investing in crypto or NFTs? So, I mean, cryptocurrency obviously has become a wide-ranging topic for debate for many people. Cryptocurrency can be a very illiquid market, and it's supply-demand based, generally speaking. So if it was something that you wanted access to your money in a short period of time, I would say that cryptocurrency, like owning cryptocurrency directly, would probably not be the best way to go about it. But there are EFTs, so exchange traded funds, that allow you to buy cryptocurrency, the cryptocurrency market, so to speak. So you can participate in the cryptocurrency market without actually buying Bitcoin or some of the other cryptocurrencies that are available right now. Sure. So a dividend is when a company has a set amount that they pay shareholders on a quarterly basis. And it's determined by the board of directors. And and their earnings. So most companies will have a cap on how much they can pay out from an earnings perspective, and it's you know, can be a percentage of their earnings. And then companies that are shareholder friendly will consistently buy back shares or will increase the dividend that they're paying to their investors. So it's a dollar amount per share that companies pay shareholders to invest in their company. It can become a percentage. So when we talk about dividend yield, you would take that dollar amount. So if it's $1 divided by $100 and give you a dividend yield. And that's when you'll hear people talking about a dividend yield. What are the different asset types for investing? So stocks, insurance, bonds, real estate, GICs, cash. Those are the different asset types when it comes to investing. Let me just think if I'm missing any. Cryptocurrency could be considered an asset type, which is a newer type of asset that's come to the market in the past few years. And I think that about covers it. Do I recommend investing in real estate right now? Sure, if you know, if you can get a down payment together and can afford the monthly payments from an investment standpoint, if you can get a renter in there to help cover the mortgage payments and the taxes, then yeah, I would recommend investing in real estate. The only difference is that with real estate, you know, you're not going to have access to your capital as quickly as you would if you invested in the stock market. So if liquidity is a concern to you, like you want to make sure that you can have cash available to you, then I would say that investing in the stock market or in bonds or cash would be better for you than investing in the real estate market. Because with the real estate market, we can tie up our cash, quote unquote, for a longer period of time. If we go through a real estate market crash or anything like that, then you'll be holding that for a longer time, and it really becomes a cash flow game. So, you know, can you afford it from a cash flow perspective on a monthly basis, and the taxes, and can you get a renter in there to, you know, cover the difference? So, so yeah. So, okay. Great. So I think we've covered all of these great questions that were sent through the chat, which is great news. Just because we only have a couple more minutes before our session is done for today. So, you know, just to reiterate, if you guys have any questions or you have any follow-up questions for me, feel free to email me or call me or reach out to me on LinkedIn. I'd be happy to get in touch with you, or you can fill out my Survey Monkey, and that will give me your contact information for me to get in touch with you for any follow-up information that you want or need. And yeah, I hope that you enjoyed today's session. I know it's a lot of information to go through in such a short period of time. So hopefully you enjoyed it, and I wish you all a great day.